And this week, our stock of the week is ServiceNow Inc. And folks, this stock is up 80% this past year. Let's take a look at what it does. Now, ServiceNow is a provider of cloud-based services that automate enterprise IT, information technology operations. The company provides applications built on its proprietary platform. And let's come down here and see what it does. The firm automates and standardizes business processes and consolidates IT across global enterprise. In other words, it creates a single system for all the enterprise information technology in a company, thereby lowering the operational costs right in here. And now ServiceNow builds custom applications for automating a customer's unique activities. And that's so important because every company is a little bit different. And folks, look down here. It has over 20,000 employees. It's a pretty big company here. So let's look at the green lines. The green lines represent ServiceNow, and we're comparing them against the average stock in our database, which are the blue lines. So when it comes to the clean surplus return on equity, and think of your bank when we talk about return on equity, would you rather put your money in a bank that's paying you 13.5%, or would you rather put your money in bank account ServiceNow that's giving you almost twice as much of that amount? Now, when it comes to net income, here's a big discrepancy. Average stock about 13%, net ServiceNow up 92%. And we have to look at this carefully when you see something this out of whack, and we're going to see why in a second. Now, when it comes to revenue, we like the revenue. The average stock is bringing in revenue for 2024 of about 7.1%, where ServiceNow bringing in about 23.8%. That's three times as much. So we like the revenue here. So let's look at the stock. Now, when we look a little closer, this is the net income. Net income are your clean surplus earnings. You take traditional accounting earnings, you take away non-recurring items, those options or include the cost of options that the company is paying its most favored management people or scientists or engineers. And you have to adjust for that, folks. The traditional accounting doesn't do that. It puts it in the footnotes, and then you got to find it. But this is what we're looking at. We're looking at the net income, and it has been going up. And then all of a sudden, between 2022 and 2023, it shot up. And that gives us a clean surplus return on equity, think about your bank, of 60% for 2023. And now it's going down a little bit for 2024, but I want you to see 2024 is still way above any other numbers except for 2023. Also want you to keep this in the back of your mind. We're going to go over it. 2021, they made $1.13 per share. 2024, they expected to make $7 a share. So keep that in mind. That's about 6 times as much. And of course, down here, these red numbers are numbers where they were losing money. And you could see this in the tech companies, you could see it in the semiconductor companies, and they all have this, or so many of them have this, where they lost money, then all of a sudden now they're making money because everything's going toward tech. Okay, retention rate 100%. We like that because that means the company is taking all the money it's making, putting it back into itself in order to grow. Now here's that net income growth, and we can see that the 5-year average is 92%, 92.5%, but that is so much because of this big jump for 2023. So that has us a little bit worried. We want to see a clean surplus ROE that's consistent, and that means the earnings are growing at a consistent pace. If we see a consistent clean surplus ROE, think Microsoft, think Google, think Apple, think Amazon. Okay, so you see what we mean. Those companies are growing their ROEs very, very nicely and consistently. Now, but let's come over here, and here's something we do like, and that is the revenue growth. The revenue growth is really pretty consistent. A little bit below 20% for 2023, but then it starts jumping up again, projected for 2024. So we're sticking around this average growth rate, which is nice, because what this company seems to be having a little problem with is it's bringing in nice increases in revenue growth each and every year, but are they consistently bringing it to the bottom line? And the answer is no, but all of a sudden they're bringing a lot more between 2023 and projected 2024, bringing in a lot more to the bottom line. So if they keep this revenue growth up and they keep that money coming to the bottom line like these 2 years in here, then we have something, folks. So when we look at the clean surplus ROE, we see inconsistency. When we see revenue growth, we see lots of consistency. All they have to do is figure out how to get it to the bottom line consistently. That's what we look for, folks, high and consistent. Now, let's look at 1 year. Black line is the S&P 500, up about 25%, and now ServiceNow is up above 80%. And look how it's holding in here this whole month of December. So this is pretty nice, and you can see the big jump it's had over the past couple of months. So they're expecting good things from this company going into 2024. Now, 5 years with the market up about 80%, this stock is up about 3.5 times that of the S&P 500. And folks, this is very, very nice in here. You can see this nice climb for 2023. But now I want to show you, this is just now. Okay, it's not compared to anything, it's just compared to itself. This is 2023. 2022, which was a bad year for the market, for the NASDAQ, for the tech stocks, for everything. It was a pretty bad year. This is 2021. So we talked about 2021 and we're going to show it again. 2021, the stock was up to almost $700 a share. Now, right now, it's up a little above $700 a share. So what are we going to look at here? We're looking at, in 2021, this stock was making $1.13. Now, maybe it was projected more in 2021 because look at the net income going up for 2022. But back to 2021, making $1.13 a share. 2024 projected to make 6 times that amount. If we go back to the stock price again, this is 2021. This is 2023, the very end of 2023. So if it's projected for 2024 to make 6 times more per share than it did here, we might expect this stock to be up here by the end of 2024. And that's one thing we look at because of that consistency in the revenue growth. So folks, we like ServiceNow as a stock for one of our portfolios, and it's going in our triple ETF. Triple ETF is made up of 3 ETFs, technology, or the top stocks, our top stocks that we pick in the technology, in semiconductor, and the QQQs. We've made one portfolio out of that, and we're putting now in that portfolio for 2024. Okay, folks, we had a pretty good week. The indices are near their peaks. The Dow has made 6 or 7 or 8 highs over the past 9 or 10 trading days. The S&P is right there. So you go out this weekend. You have a good weekend. It's the New Year's weekend, so you stay safe. And, folks, we'll see you back here on January 2nd. So, folks, go out there, be with your loved ones, stay safe. Have a happy New Year.